Nilesh Shah joins me right now. He's Managing Director and CEO at Axis Capital. Nilesh, thanks very much for your time. Great to have you with us here in our studios. Did you expect this move coming, Nilesh, that has taken us all the way to 67, 6,800 on the Nifty?
Definitely there was a lot of skepticism in the market, and that gave some confidence that yes, the markets can move up. We are just little above what we had achieved in 2008, and in last 6 years, economy has almost doubled, profits have doubled, and valuations have come down from more than 20 times to probably just around 13, 14 times. So this is not a surprise, but clearly the speed, especially in the month of Feb and March, is something which is a bit, not expected.
Has some of that skepticism come down now?
Definitely, if we see on a fundamental basis, we are at a stage where macros are improving. In the short term, while interest rates are moving up, both on the market side, not necessarily on the policy rate side, but over 1.5 year, one can expect some amount of softening of interest rate. Growth, we are probably seeing the bottom. Last 2 years were below 5% growth. Expectation is that next year the growth will start bottoming out and moving up. Inflation has been a bugbear for last couple of years. Now that's softening, and we will see CPI inflation coming down to around 6% level towards the middle of the current year. We are also seeing appreciation of currency, and at least that strong weakness which was witnessed in currency market, that has disappeared. The current account deficit has come down dramatically. Fiscal deficit has remained reasonably under control. So there is a strong platform in terms of macro which gives incentive or which gives opportunity for market to build up. More importantly, we have also started outperforming our peers by a big margin. I mean, if we compare ourselves on a 3 months basis or a 1 year basis vis-a-vis Brazil, Russia, China, we have appreciated significantly, whereas all of them are giving negative return. So there is increased interest from foreigners looking at the peer position to invest in India, and improving macro with FII flow, that's creating a catalyst or a combination for markets to leap higher.
What guidepost do you use to say, well, whether things are overdone or there is much more still left? What are the 2 or 3 guideposts or matrices that you use, Nilesh?
So effectively, the starting point is always the valuation. And today we are just trading around our average valuation. This year no one would have expected, but actually the Sensex companies have delivered almost 15% earnings growth. My feeling is that next year also that will be continued. So this huge earning growth keeps our valuation under check, and we are just trading around average valuation for the market as a whole. Now if we go sector-wise, consumer staple is one sector where valuations are at all-time high level, prices are near all-time high level. But bearing that, all other sectors are either around their average valuation level or, more importantly, at the bottom of their valuation level. So valuation gives huge confidence. The second thing which probably one can look at is the, in terms of macros, is the macro going to deteriorate or is the macro going to improve? So it's like running on an upward slope or running on a downward slope. If macro is improving, then you're running on a downward slope. And if valuation is in your favor, then the wind is with you, not against you. So this valuation and macro situation gives the confidence, and then you build up your portfolio stock-wise, sector-wise to participate in the uptrend in the market.
So 2 parts, right? One is valuation, where you're saying that valuations are average, and the other is our macros are going to get better, and you're saying valuations are not stretched yet, and the other is macros will keep on getting better.
Yes.
That's the hope, right?
I mean, valuations are fair value, just around average, and they have a room to go up.
So let's talk about that, right? Valuations will depend on earnings growth.
Yeah.
Fiscal 15 earnings growth, you said expected is 15%?
Around 15%.
How realistic is that, Nilesh?
So we have the benefits of 2-3 things. We are a net importer of commodity. Now commodity prices worldwide has come down dramatically. Second, in FY13 as well as partially in FY14, we had to suffer from the overvalued rupee. It made our manufacturing sector uncompetitive vis-a-vis imports. we were not able to export ourselves because of the overvaluation of rupee. Now rupee is, at a fair value. No one can say that it's either overvalued or undervalued, and this gives huge competitiveness to the Indian industry. We will see import substitution theme playing out, which creates more manufacturing and more jobs in India. We will see exports gaining momentum, which again creates more jobs in India. The third thing which is probably going to help us is that the inflation seemingly is coming down. Now, there will be some components of inflation which might impact industry or sectors. There will be some component which will benefit, but overall softening of inflation will create that huge advantage for the corporate India. The other thing is that last 5 years were pretty tough. It resulted into corporates resorting to lots of cost control measures. Now the benefit of that cost control will be reflected into the earnings. So overall, if we put all these things together, we are at a stage where platform is built for earnings to grow, and as earnings grow, Indian equity markets will also get supported by pickup in the valuation.
What about, so the second part of the guidepost, right, which is macro pickup. As aggregate demand picks up, won't firms across the board increase prices? That will contribute to inflation, and it will happen at an aggregate level, but it's bound to happen.
So we have seen inflation coming through various mechanisms. So let's look at CPI. Now 25% of CPI is related to housing inflation. Now is housing inflation calculated on the actual rent, which has remained pretty soft over the last 4-5 years? Unfortunately, we calculate inflation based on the HRA allowances, and which keeps on growing up 10-15% every year. So in some sense, what is the salary component, wages and salaries, is getting reflected in CPI inflation, which may not be there the case in the Western world. The second thing is that inflation in Indian context is also driven a lot by the spikes which are caused. So you have scenarios where a large portion of particular commodity like onions from Maharashtra or tomato from Andhra Pradesh or cauliflower from West Bengal comes, and if there is a seasonal disturbance over there, there is a spike, and then it gets translated into inflation. So undoubtedly all this idiosyncrasies creates pressure on the inflation side, but as we move forward, one, the markets have become competitive, so corporate India will have to play through productivity gains rather than pricing power coming out of the softening inflation. And my guess is that today a lot of corporate India is far more focused on cost control measures, productivity gains, and improving their efficiency rather than taking the last straw out of the consumer's pocket.
So 15% earnings growth, which sectors will that be led by? Let's just sort of disaggregate that number a little bit.
The typical sectors where the earnings growths will be higher will be driven by, one, the defensives like pharma and technology, second by the financial services, and third by the consumer staples. But more importantly for us, we'll have to see what market is factored in terms of earnings growth vis-a-vis what actual growth is coming through. And we believe over here the consumer staples sector probably will continue to see earnings growth, but that earning growth will be lower than what is expected by the market, and that earning growth will not be able to support the valuation which these companies are enjoying. Unlikely that consumer staple stocks will come down in terms of price because there is hardly any supply over there, but they'll continue to remain where they are for some amount of time and allow earnings to catch up with them. So while the earnings growth will be led by the sectors, it is the delta or the change in the earnings which will be important to drive the stock prices.
So if you have to focus based on earnings-led valuation increase, you'd focus on
so
tech?
There are 2-3 sectors or 2-3 themes which we are looking at. The first and the most important one which we believe is that you have a scenario where certain cheaply valued private sector banks will outperform both public sector banks as well as the more expensive private sector banks. Clearly, market has placed huge amount of expectations on those higher valued stocks, and as they have to keep on delivering on those higher expectations. At some point of time, those stock prices will correct, or those stock prices will stagnate in order for earnings to catch up with the valuation. So first call is that private sector cheaply valued banks will provide better opportunity vis-a-vis public sector banks and expensive private sector banks.
Names would be helpful, Nilesh, if you can.
I can't comment on a stock specific basis, but most people will be able to understand what I'm talking about.
Cheaply valued private sector banks should do much better than PSUs and more expensive, larger private sector banks.
Yeah.
That's the call. Okay, so that's
the second call which we are taking is that there are certain companies in the engineering space which are either getting outdated in terms of their technology application, or they are getting burdened by the salaries and wages and historical cost. So you will be probably better off staying short of such companies who are not competitive either because of their technology or because of the high cost, mainly driven by the historical wages and salaries bill. On the other hand, there are companies, especially multinational and couple of Indian, which are actually introducing newer technology from their parents or from their acquisitions, which are putting up new factories and which are fairly cost efficient. And in many cases, the difference between the salaries and wages bill of an old engineering company vis-a-vis new engineering company is more than the profit margins which are available in that sector. So one trade which will make money for investors will be long MNC and couple of modern Indian engineering companies and short some of the old Indian engineering companies where their competitiveness is reduced because of the salaries and wages bill and because of the available lack of modern technology.
These are capital goods makers.
These are the capital goods maker.
Right.
The third thing which we believe should be better off going forward will be related to import substitution. As I mentioned earlier, rupee overvaluation had created uncompetitiveness for Indian manufacturing industry. A lot of industries across various verticals like engineering, paper, other manufacturing items, they were all getting driven down by the cheap imports from all over the world, mainly led by China. Now, rupee depreciation or rupee fair value is giving this industry a competitive advantage. They are all operating today at a much lower capacity utilization. And as they start moving up either in local markets or in exports market, the delta of earnings which will come to them will be significantly more than what market is priced in today. So we will see this import substitution theme working well over next 12 to 18 months.
What are the chances that the market really takes off and we see a bull run, Nilesh? That's something increasingly one hears. Actually, one heard that even a year back, but now we're about 400, 500 points higher than the previous high. What is your sense? Can the market go parabolic?
So today, for markets to go parabolic, we need two things. The flow of money has to be strong, or the optimism about the future has to be at its peak. Now, in terms of flow of money, we do see FIIs bringing in their money. They have been bullish India. They have invested more than 35,000 crore in debt. They have invested about 22,000 crore in equity in last quarter, year to date. So clearly, FIIs are pumping money into India. It's probably driven by the fact that Indian markets have outperformed their emerging market peers handsomely over last 1 year. Second, Indian macros today look far better vis-a-vis other emerging market peers like China, Brazil, Indonesia, Turkey. So from an FII point of view, definitely one can expect that this momentum of flows will continue. Obviously, we need to worry about Fed tapering. In May 2013, when Fed first announced the word tapering, our markets had corrected. But when the actual Fed tapering began in December 13 till today, the markets have actually gone up. So while we will keep a watch on a Fed tapering and its impact on flows to Indian market, but it is fair to be positive on FII's flow, continuing the momentum in the Indian market. So the delta will probably now come from retail Indian investors' participation. we run a direct trading portal called Access Direct, where we are seeing our highest ever participation from retail investors all over the country. More than 6,000 people trade on that every day, and we are seeing our highest ever volumes in last 3 years. So from a participation point of view, retail investors are there. Now we just have to convert that participation into buys rather than sells. And I believe that we are at a stage where retail Indian investors will see a tectonic shift in terms of their allocation. Today in their balance sheet, they are much overweight physical assets like real estate, gold, and fixed income assets like bank deposits, tax-free bonds, and so on and so forth. Just less than 6% of their financial portfolio is allocated to equity, including equity mutual funds. This is probably one of the lowest ever allocation by retail investors in their balance sheet to equities. Going forward, I expect a tectonic shift from one, physical assets to financial assets, and within financial assets from debt to equity. And this trend, I don't know when it will work, but certainly over next 18, 24, 36 months it will work, and it will get complemented by the FII flows, and that could put market into higher orbit. Now obviously markets will have to cross various event hurdles like the election results, like the monsoon and El Nino, like the Fed tapering, but then that's part and parcel of any market movement.
So retail, I would assume after listening to you, is still selling, because you said you have to convert that into buys,
Yes.
right? So I would assume retail is selling. And second, you said participation is at a 3-year high, but compared to say 2006-07, it's still a fraction?
Unfortunately, we were present in 2006-07.
I mean, you know the industry.
Yes, overall, the momentum and the frenzy which we had witnessed in retail investors during late 2007 and early 2008, that's certainly missing in 2014. But from a participation point of view, now I'm seeing the highest ever volume on Access Direct, and majority of that is sale rather than buy. But my feeling is that as this tectonic shift happens from physical assets to financial assets, and within financial assets from safe assets to risk assets, I think equity allocations will increase tremendously over next couple of years.
But that's the key, next couple of years, right? So that for investors to come in and buy stocks now, don't you think that will have to wait till the economy picks up? People feel good about their own prospects. The real economy. I mean,
undoubtedly.
That's what we saw in 2006-07 as well.
Undoubtedly.
Salaries were going up and people wanted avenues for investment, right?
Undoubtedly, but we can make their life easier by giving them a path so that the water can find its own level. Now, two standout events which has happened in last 3 months. One was the Power Grid FPO, where we saw 400,000 retail applications coming in because they could clearly see that they were getting Power Grid shares at about 85 rupees, whereas in the market it was trading at about 100 rupees. There was money on the table, and 400,000 retail investors did capture that opportunity. The second thing we saw was the PSU ETF, where government kindly provided 6% upfront incentive and then some amount of incentive if you hold it for 1 year.
Yeah.
And now PSU ETF today has debuted at a premium, giving good return to the investors. So this two pleasant experience hopefully will entice more retail investors to participate. And then if the event risk is behind us, especially the election, maybe that positive experience will continue to gather further steam. And then they will suddenly see that, look, I'm too much overweight real estate and gold, where the returns are not as good as the past was indicating, whereas equities, where the returns are not there in the past, but in the future it could be looking much better, and then the allocations will start shifting. So we need to provide them that positive experience which PGC and PSU ETF has provided, and then go for their allocation.
Right. No, but so then you're saying, then the answer to my original question of a big parabolic move, that's ruled out for now, right? Would you say
It can
that?
happen with the support of the event. So if events are in your favor, the El Nino doesn't materialize, the election results are for a pro-reform, stable government, and the FII flows and retail flows continue, then the parabolic move can happen.
Let me ask you this. On the 16th of May is when counting is and we get election results. If the Nifty is at about 60, 65, 6600 or so, what's your sense? What do we see? And the outcome is as desired by the market, which opinion poll outcomes, etc. Market likes, right? What
So,
they're seeing. And
as
if
of
the
today-
actual outcome is that, what's your sense?
So as of today, markets has priced in a pro-reform stable government. Market is also pricing it that there will be several steps taken by the new government in terms of continuing the momentum which has been built on the improving macro side. So your CAD has been brought under control. People expect that now exports will pick up, imports will probably get subdued, and CAD will continue to improve further. On the fiscal deficit side, for the FY14, numbers have come as per the expectations of the market. Now the expectation is that there will be more fiscal consolidation over there. The third thing is related to growth. For last 2 years, we have been growing below 5%. Now the expectation is that the growth will gather momentum and it will cross 5% to 6% level and eventually to higher levels. The growth has slowed down primarily because investments have fallen off. The savings have come down, investments to GDP ratio has come down. So steps needs to be taken to revive investment, which will support growth, which will sustain growth. So market is pricing in all these improvements in the next government, and if next government delivers to those expectations, certainly markets will be on a stronger platform.
But I'm talking about the next 40 days, Nilesh. A lot of this thing, will, what you spoke about, will take time. 16th of May, will we see if you get numbers for the NDA as polls are outlining right now, which is what the market desires, right? If you get that, will we see a repeat of 2009? So two 10% moves on top of 65, assuming the market is at 65 then? What's your sense?
If the market is at, say, around current level, then to some extent it has already priced in the pro-reform stable government, and we may not see a big spike as much as 2009, but we will certainly see an up move. The magnitude of that up move might be a little lesser than 2009.
Okay. That's, I know it's a up in the air kind of question, but just wanted to sort of get your thoughts on that. I just have one last question. So in all of this, I would reckon that global liquidity is still very important, right?
Yes.
It drove the last bull market. Liquidity conditions were eased even more after the global financial crisis, and now for the first time in many years, it's being tightened. So that's essentially what is happening. Markets, of course, have paid no attention. US markets are at new highs. To many, it's perplexing. But what's your sense? What's your sense on global liquidity itself?
So there are a couple of points to keep in mind. Point number one, while US is tightening, Europe and Japan are still on the easing mode. So one door is closing down, albeit very, very slowly, but there are two other doors which are open. Second, we are receiving about $20-30 billion from FII flows and about $20-30 billion by way of FDI flows. $60 billion is not a very big number in the pool of global liquidity. For last 30 years, China has received more than that every year. So clearly, if India wants to be nearer China, that kind of flows can accrue to us, provided we deliver in terms of growth and other macro factors. Third, while Fed is tapering off, it's tapering off on an incremental liquidity. But the liquidity which is already pumped in, so the stock of liquidity which is already there, that's fairly large. And even if we can dent from that stock of liquidity, we will not have to worry about the tapering like what we have seen in last 3 months. Fourth, when the tapering word was announced, we corrected far more when the actual tapering began. So my sum and substance from all this observation is that as long as we can deliver on growth, as long as we can deliver better than what our peers are delivering in emerging market, then I think out of the global liquidity to get $60-70 billion every year should not be too much of an Herculean task.
That's well put. Nilesh, thanks very much for dropping by. Great to hear your thoughts on the market and macros as well. And hope to have you back soon.
Thank you.
Thanks very much, Nilesh.